Warren Buffett bet $1 million that a strategy any beginner could use would beat the smartest hedge fund managers on Wall Street. He won, and it wasn't close. 2007, Buffett challenges the entire hedge fund industry. A hedge fund manager named Ted Sides takes him up on it. The bet is simple. Buffett picks one index fund, a fund that just buys every stock in the market and holds it. Sides picks 5 hedge funds run by some of the most expensive money managers alive. 10 years. Whoever makes more money wins. Buffett's index fund returns 125.8%. The 5 hedge funds, 36% combined, a gap of nearly 90 percentage points. The simplest possible strategy demolished the most sophisticated one. So what happened? Hedge funds charge what's called a 2 and 20 fee structure. That means 2% of all your money every single year, whether they make you anything or not, plus 20% of any profit they generate. Over the 10-year bet, fees consumed roughly 60% of the hedge fund's gains. The fund's actual investments did okay. The managers just kept most of the money. But the bet wasn't a fluke. Over any 20-year stretch, 90 to 95% of professional fund managers lose to the index. The Spiva scorecard proves this isn't just one bad year. It's a consistent 20-year average. Roughly 9 out of 10 professionals whose entire job is to beat the market cannot beat the market. And market timing? Even worse. Between 1980 and 2022, the S&P 500 had roughly 10,500 trading days. If you miss just 10 of those days, the 10 best ones, your total return gets cut by more than half. 10 days out of 10,500? You would have to be perfect. Nobody is perfect, not even the people who get paid millions to try. So if stock picking fails and market timing fails, what actually works? The answer is boring on purpose. It's called a 3-fund portfolio. 3 funds. That's the whole thing. Fund 1, a U.S. total stock market index. It buys a tiny piece of basically every company in America. Fund 2, an international stock market index. Same idea, but the rest of the world. Fund 3, a bond index. Bonds are basically loans to governments and big companies. They're the boring safety net. 3 funds, over 10,000 securities, dozens of countries, set up in 10 minutes. Then you do something called dollar cost averaging. You invest the same amount every month, no matter what. Market goes up, you buy. Market crashes, you buy. During the 2008 crash, the market dropped roughly 50%. Most people panicked and sold. Dollar cost averagers, they kept buying at half price. Those shares bought at the bottom became some of the highest returning investments of their lifetime. Crashes aren't the enemy for people who keep buying. They're a sale. None of this would exist without one person. 1976, a man named Jack Bogle creates the first index fund. Wall Street laughs at him. They call it Bogle's folly. He tries to raise $150 million. He gets $11 million. Today, Vanguard, the company Bogle built, manages over $8 trillion. From Bogle's folly to $8 trillion. Because the boring thing was the right thing. The greatest investing strategy in history requires no skill, no research, and about 10 minutes a year. The only thing it requires is the discipline to do nothing. If you like stories like these, please like and subscribe.